Today we will talk about simple candlestick patterns you need to know right now. Candlestick patterns have been an essential part of technical analysis for centuries, originating from Japanese rice trading and later being adopted by modern financial markets. These patterns provide a visual representation of price movements, offering traders valuable insights into market sentiment, potential reversals, and trend continuations. While there are many complex candlestick formations, some of the most effective patterns are also the simplest. Understanding these basic patterns can help traders make informed decisions, whether they are trading stocks, Forex, or cryptocurrencies. This guide will take you through some of the most important simple candlestick patterns, explaining their significance and how they can be used to identify profitable trading opportunities. The Doji. A sign of market indecision. The Doji is one of the most well-known and fundamental candlestick patterns. It forms when the opening and closing prices are nearly identical, resulting in a candle with a very small or non-existent body. The Doji indicates a state of indecision in the market, where neither buyers nor sellers have managed to gain the upper hand. This pattern is significant because it often appears before major price reversals or breakouts, signaling that traders should be cautious. There are different variations of the Doji pattern, each with slightly different implications. The Dragonfly Doji, for example, has a long lower shadow and no upper shadow, meaning that prices dropped significantly during the session but then recovered before the close. This suggests a strong rejection of lower prices and can be a bullish reversal signal if it appears at the bottom of a downtrend. On the other hand, the Gravestone Doji is the opposite, forming when prices rise significantly but then retreat before closing near the opening level. This pattern often signals a bearish reversal, especially when found at the peak of an uptrend. The long-legged Doji features long upper and lower shadows, showing extreme volatility and market uncertainty. It often appears before major trend shifts, making it a critical pattern to watch. The Hammer and Inverted Hammer. Reversal signals. The hammer is a bullish reversal candlestick pattern that appears at the bottom of a downtrend. It has a small body near the top of the candle and a long lower shadow, indicating that sellers pushed the price lower during the session, but buyers managed to regain control before the close. This shift in momentum suggests that a potential trend reversal could be on the horizon. Traders often look for confirmation, such as a strong bullish candle following the hammer, before entering a long position. The inverted hammer is a variation of the hammer but appears in the same context, after a downtrend. It has a small body near the bottom and a long upper shadow, suggesting that buyers attempted to push the price higher but met resistance. Despite this, the presence of the inverted hammer signals that bearish momentum is weakening, and a reversal could soon take place if confirmed by further bullish price action. The Shooting Star. A bearish signal. The shooting star is the bearish counterpart to the inverted hammer, forming at the top of an uptrend. It has a small body near the lower end of the candle and a long upper shadow, indicating that buyers tried to push the price higher but were ultimately overpowered by sellers. This shift in control suggests that the uptrend might be losing steam and a potential reversal to the downside could be imminent. The shooting star is most effective when it appears after a strong bullish trend and is confirmed by a subsequent bearish candle. The engulfing patterns. Strong reversal signals. Engulfing patterns are two candlestick formations that signal powerful reversals. There are two types of engulfing patterns: bullish engulfing and bearish engulfing. The bullish engulfing pattern occurs when a small bearish candle is followed by a larger bullish candle that completely engulfs the previous candle's body. This pattern suggests a strong shift in momentum from sellers to buyers and is a strong indication that an uptrend may be beginning. It is particularly effective when it appears after a prolonged downtrend, as it signals the potential start of a new bullish phase. Conversely, the bearish engulfing pattern forms when a small bullish candle is followed by a larger bearish candle that completely engulfs it. This pattern suggests that buyers have lost control and that selling pressure is increasing, which can lead to a downtrend. It is most effective when it appears after a strong uptrend, as it signals a potential market reversal. The Harami pattern. A subtle shift in trend. The harami pattern is another two-candlestick formation, but unlike the engulfing pattern, the second candle is smaller and fits within the body of the first candle. This pattern indicates that the existing trend is losing strength and a potential reversal could be on the horizon. A bullish harami forms when a small bullish candle appears within the body of a larger bearish candle, suggesting that selling pressure is weakening and a reversal to the upside may be approaching. This pattern is most effective when it occurs at the bottom of a downtrend and is followed by further bullish confirmation. A bearish harami, on the other hand, forms when a small bearish candle appears within the body of a larger bullish candle. This suggests that buying pressure is fading and that a potential bearish reversal could take place. It is most significant when found at the peak of an uptrend, as it indicates that buyers are losing momentum. The morning star and evening star. Trend reversal patterns. The morning star is a three-candlestick pattern that signals a bullish reversal. It consists of a long bearish candle, followed by a small-bodied candle, which can be bullish or bearish, and finally, a strong bullish candle. This pattern suggests that selling pressure is subsiding and buyers are gaining control. The presence of the small-bodied candle in the middle represents market hesitation before the reversal. When confirmed by a strong bullish candle, the morning star is a powerful indication of a new uptrend forming. The evening star is the bearish counterpart to the morning star. It appears at the top of an uptrend and consists of a long bullish candle, followed by a small-bodied candle, and then a strong bearish candle. This formation indicates that buying pressure is fading and that a bearish reversal is likely. Like the morning star, the key to confirming this pattern is the strength of the final candle, which should ideally close below the midpoint of the first bullish candle. Understanding simple candlestick patterns is an essential skill for traders looking to analyze market sentiment and identify potential trading opportunities. Patterns like the doji, hammer, shooting star, engulfing, harami, and star formations provide valuable insights into price movements and potential reversals. While these patterns can be highly effective, they should always be used in conjunction with other technical indicators, such as volume, trend lines, and support and resistance levels, to improve accuracy. By mastering these fundamental candlestick patterns, traders can make more informed decisions and increase their chances of success in the financial markets. What do you think of our video? Let me know in the comment section below. Also subscribe to our channel before you go. Thanks for watching.